Okay, welcome back, everybody, to the Today's Market Explained video and podcast series from Four-Star. And as you know, we do market commentaries that come out periodically throughout the month. And then we also do interviews with very interesting players in the financial system, people we meet that we think others would like to meet. And so today we have a very interesting character, and he's actually a graduate of my business school as well. So we're compatriots in there. I want to welcome to the podcast, Zack Ellison. Zack, welcome to the Today's Market Explained podcast.
Thanks, Brian. I appreciate you having me on.
Excellent. Well, good. Besides going to the right business school, University of Chicago, I'd like, if you would, for you to introduce yourself to our listeners. Tell us just a little bit about you.
Sure. So I've spent the last almost 20 years now in the fixed income markets in various roles. And I came out of Swarthmore College in right outside of Pennsylvania, or outside of Philly, I should say, and got my start in New York City in 2004, and basically started working my way up. And my first kind of big job was at Scotiabank, starting in 2007, and I was underwriting leverage loans predominantly in the media and telecom space. And so when I started there, everything was great and very rosy in the markets. And then we had the worst recession of our lifetimes, and it became a great learning experience. And I was fortunate because Scotia, as a Canadian bank that's very strong in credit, it was a good place to be during that time when a lot of banks were going out of business. So I wound up managing about $2 billion of our team's $6 billion loan portfolio, and got to work on some really interesting opportunities. A lot of credits became stressed at that time, even high quality companies. But it was really a learning experience of all the things that can go wrong in a down market, and things that you don't necessarily think about in a bull market when things are good. But every little crack in every deal becomes magnified when things get tough. So I learned a lot of lessons relatively early in my career. And I was at Scotia through the middle of 2010 when I decided to go back to business school at University of Chicago, Booth School of Business, which I think was ranked the #1 business school again this year by US News and others.
Sure, absolutely.
Yeah, so got to give them a little shout out. And so I went to Booth and moved to Chicago and lived in the Loop, and really enjoyed my time there, and spent my time really focused on analytic finance and economics, were my two majors. And decided I wanted to transition from banking into trading. And I was fortunate to get a role at Deutsche Bank in New York. And when I came out of Booth in 2012, I think I was the only credit trader hired globally by Deutsche Bank that year, certainly in the US. And that was a great learning experience. Some of the people I worked with were some of the best in the business. And I had my liar's poker moment there. And when I think it was roughly, it must have been 2012, maybe it was 2013, Deutsche Bank led the Apple deal, which at the time was the biggest bond deal in history. Wow. And the lead trader of Apple sat right next to me. And I remember when the bonds were free to trade late in the day, the entire trading floor at 60 Wall Street stopped and watched him trade these bonds, right? And it was just, it was a crazy experience. I still get goosebumps thinking about it because I was, a young guy then. I thought one day I'm going to get to do this. I better be ready for it. And so I had a great experience at Deutsche Bank. At the time, I think we were #1 in fixed income, actually, and the biggest bank in the world in terms of assets. We were 2.8 trillion in 2012. So it's kind of like the seat I always dreamed about getting, and was really fortunate to get it, and learned a lot there. But then decided I wanted to move from the market making side, where I was trading bonds and credit default swaps, to the buy side, where I'd be more of a portfolio manager, making longer term investment decisions. So I left Deutsche Bank to go to a company called Sun Life, which is one of the biggest insurance companies in Canada, and also owns a number of big asset managers like MFS in Boston. Yes. I think aggregate Sun Life now manages about 1.4 trillion. So I moved back to Boston, where I'm from and where the US team is based, and was part of a really good team managing about 25 billion in fixed income, mostly longer duration investment grade bonds, but also treasuries, floating rate securities. I think we had about 70 portfolios that we managed. And so it was, every day was fun and different and challenging. And I learned a lot there about how big, smart institutional investors think about the world. And I was lucky too, because I got to interface with Wall Street every day as one of our traders as well. And so, every day I was getting to talk to some of the smartest people on the street, whether it was strategists or traders or research analysts. So that was probably the best learning experience I've had. And so that took me to kind of where I am at now, which we can talk about, which is, I saw this big opportunity in the market where I thought, well, so let's go back to 2017-ish.
Okay.
And at that point, I was thinking about how corporate bonds were going to perform over the rest of my career and what my career opportunities look like in the segment. I thought, wow, yields are very low and they're going to have to rise at some point, which means there's going to be losses.
Right.
The market was becoming very commoditized, and bonds were starting to become traded electronically, much like stocks were. And a lot of people don't really realize this, but bonds are an over-the-counter product, an OTC product. And historically, to trade bonds, you would call up a broker-dealer on the phone and you would negotiate the bond price verbally. And then in time, that kind of transitioned to messaging on Bloomberg, like chat messages. And when I was at Sun Life, it was really moving towards more of a full electronic trading setup. And that was kind of the big theme in the market at that time, from like 2015 to 2017. There was a lot of talk about liquidity and how to get liquidity quickly, how to get best execution trading, where you're not paying a lot of bid-ask spread to trade bonds. So long story short, what that meant was you had commoditization of the product, electronification of the product, which was compressing spreads, meaning there was less money to be made as a broker dealer, certainly. And yields were very low. So as the yields were going to rise, that was going to hurt the total return. And I thought, there's got to be a better way to make money in fixed income outside of corporate bonds. And because I'd had experience at Scotia underwriting loans, I was looking at private market strategies on the lending side. And at that point, I discovered a strategy which is called venture debt, which essentially is loans to venture-backed companies that are relatively late stage. They're in the growth stage, so they're actually kicking off revenue. They're doing very well, but they're looking for additional growth capital, and they're willing to pay a relatively handsome amount, typically 15 to 20% each year, because for them it's still a lot cheaper than equity financing. And wow, this is a really interesting part of the market because innovation is going to keep becoming more prevalent. Technology is really where value is being created most often. And this was a part of the market that had proven strategies that worked, but there wasn't a lot of competition. And so it was basically an inefficient part of the market. And when I say inefficient, I mean there were a lot of information asymmetries. It wasn't like a commoditized product like a 10-year treasury or a large cap stock where we all have the same information at the same time. There were people who knew things that would give them a competitive advantage. And so that was one thing that was very appealing to me. And another thing about the industry is it's very fragmented. Most of the deals were getting done in San Francisco or the Bay Area, and to a lesser extent, New York and Boston. And outside of those three cities, there weren't really that many deals getting done in the venture ecosystem. And so I thought, wow, we've got this huge country with a ton of smart people, a ton of founders, and a ton of capital. And it's going to keep growing. There's going to be more founders coming to market. The smartest people in the world that were coming out of top schools weren't really looking to go work at investment banks or consulting firms anymore. They were really looking to go to a startup or work for a tech company. And so the writing was kind of on the wall that innovation was going to be the value creation driver. And so the next logical step was, well, how's it going to get funded? At that time, it was getting funded, probably 92% of the funding was equity and 8% roughly was debt. In terms of the capital that was being deployed each year. And I thought, well, this is going to change as this ecosystem grows bigger and more sophisticated, founders are going to naturally be looking at other funding options that are better for them. And
Right.
the funding options on the debt side are better for them because they're cheaper and they're much less dilutive. So you're not giving up this big ownership stake to raise capital. You're borrowing capital, and it's also quicker to raise, which is very important for startups where time is everything. I kind of think of time for startups as dog years. If 6 months at a big mature company is nothing, 6 months for a startup could be life or death. And so if you're able to raise debt capital in 4 to 6 weeks versus 6 to 12 months to raise equity capital, that could mean all the difference. So long story short, I essentially saw this opportunity, and I had the skill set having underwritten loans, traded credit, and managed credit portfolios. And I thought, this is where the market's going, and I want to bet my career that this is going to be the opportunity of a lifetime, essentially. So I started building out ARI, and a couple of years later, here we are.
Right. So how big is the company now? How many people?
So right now we have 4 full-time people on our investment team, and so we're still small, but it's small and nimble.
Yeah. Well, you brought up a really interesting point that entrepreneurs at some point would look to find capital that was more advantageous to them, because normally everyone wants equity. If they're going to give you capital, they're going to want equity. They're going to want to make a big hit if you win big, and they want to get the biggest returns possible, and that would be equity. But that's not always necessarily what the entrepreneur wants, right? The entrepreneur wants to keep control of the company, and maybe I'll pay some generous coupon debt, but I don't want to give up control. So that's part of what this is about, right?
Yeah, that's a huge part of it. And so I always think of it from the founder's perspective, and then the investor's perspective, and then the lender's perspective. So there's 3 perspectives that I'm always thinking about. And from the founder's perspective, the big advantage of debt is it's a lot less dilutive. Well, technically, debt's not dilutive at all, but a lot of these deals on the venture debt side have equity warrants attached. So the lender will have equity upside in the deal. And typically, it's not a huge percentage, but it could be 50 basis points of the company's equity. But it winds up being a lot smaller chunk of equity than a straight equity raise. So that that minimization of dilution, right? Plus the fact that it's cheaper, cost of debt all in is, call it 15 to 20% versus multiples of that for equity. And the fact that it's faster to raise all makes that a very attractive option. But one thing I should mention is it's not necessarily a substitute for equity. It's really a complement for equity funding. And so the way it works in practice, and I should kind of take a half step back and describe what the strategy entails. So traditional venture debt is to growth stage companies that have completed a Series B round of funding. So most of the venture debt is going to Series B through D companies. So these are companies that have already raised a friends and family round, maybe did an angel round, a pre-seed round of funding, a seed round, and then they do their Series A, which is their first, what I call institutional round of funding, where larger VCs come in and invest. And then by the time they get to Series B and Series C, they're producing revenue. And that's one of the key attributes that venture lenders look for, is these are companies that are past the concept stage and they're actually kicking off revenue. And so at ARI, for instance, the minimum revenue we look at is typically 10 million. And the average company would have a revenue range of, call it like 10 at the low end, all the way up to 100. And it could be bigger, but not smaller. And there's a lot of companies that fall into that zip code, and they've got enough revenue to service the debt, meaning they have enough revenue to pay the interest each year and then pay the principal when it comes due. And so they're really, they're happy to utilize debt. But here's where the debt comes in. It's after the company's completed a relatively recent funding round on the equity side. So I'll give you an example. So say a company wants to raise $50 million. What they would do, instead of raising all 50 by selling equity, is they would raise 40, for example, on the equity side, And then 3 to 6 months later, they would add 10 in debt. So they still raised their 50 million, but now they've saved themselves that $10 million of dilution, and they've lowered their weighted average cost of capital. Now, from the lender's perspective, it's attractive because we get to see the company meet its milestones, raise the money, and we know that they've got traction. And we can look at their numbers and say, okay, they went through a due diligence round with a bunch of equity VCs. They successfully closed a large round of capital. They've got a lot of cash on their balance sheet. They've got strong revenue growth profile. Now we're going to make them a loan. And so it really reduces the risk. It's a very different risk profile than I think a lot of people think before they learn more about it. It's really the safe way to access venture-backed companies. That's how I think about it, the safer way to access innovation.
So Zach, you know that I was one of the Hyde Park Angels at our alma mater at the University of Chicago Business School, at Hyde Park Angels. And we would do deals where we would get convertible debt that we would get interest on immediately, but then it would convert to equity. That sounds like nirvana, right? So you get equity returns later, but you get interest right now. And that only happens probably because the entrepreneurs are very desperate. But when you get to the venture level, they've already had some revenue. They're already at a different level. They can dictate more terms, right? And that's kind of what you're talking about, is that they get a better arrangement by going with debt rather than equity, and they don't have to give up the interest to the debt holder, to the equity holders. They would only give up interest to the bondholders.
Yeah, I mean, it's a package where everybody wins, right? The founder gets cheaper capital. Their existing investors like it as well because they're not getting diluted further either. And oftentimes it helps de-risk them because they want to see their companies be successful. And the more money the company has, the higher the probability of success. But sometimes the VCs don't have any more money to put into the company, right? So they're out of cash, or maybe they're not out of cash, but they've allocated all they're going to this particular company. But then the debt financing provides the company with additional capital, de-risks it further, and the existing equity holders don't get diluted any further. So they like it. And then, of course, the investors into the venture debt fund, like our investors, for instance, like it because they're getting a relatively safe return that's kicking off 15 to 18% cash yield plus equity upside, which historically has been worth about 5% annualized as well. Yeah. So actually, one thing I should mention from the investor's perspective that's nice is these loans are all floating rate. And so in this environment where rates keep going up, it's one of the few credit products that's actually outperformed and not lost money. In fact, the coupon's gone up roughly 4% because prime rate has increased almost 4% in the last 9 months or so. And that's really attractive. So you've got two ways that this product hedges interest rate increases. One is the floating rate. The other is these equity warrants that are typically 10-year expiries. And what's nice about warrants is it's essentially a call option on the company's stock, right? And one of the best long-term hedges for inflation is long-dated call options, because as inflation increases, it pushes up the value of everything, the price of everything, right? As the price of everything increases, the price of your call option is going to increase, and the value of your call option is going to increase. So it's one of the few fixed income products out there that doesn't actually have any interest rate risk.
Right. It is interesting, and what you're talking about is actually first getting debt and then getting warrants. So you're getting equity after the debt, if it works out, which is the exact in the early seed round funding.
Mm-hmm. Exactly. Yep.
So Zach, it was really good to hear your journey about how you came to the idea that venture capital debt might be a very good place to be for investors and for you as a business person. So it's good to hear that. Who did this before? There was dedicated venture. Was there any venture debt? It was a Silicon Valley Bank, or what did it look like?
Yeah, so I'll map out the competitive landscape. So there's basically two markets. There's the bank funding market, right, and there's the non-bank lenders. So on the bank side, Silicon Valley Bank is the biggest by orders of magnitude, and historically they've had market share that was probably 2/3 of the market. It's less today, but it's still probably at least half the market. Right. And there's other banks as well, like Bridge Bank is a big venture lender. Comerica has historically been a big venture lender. And those are really the big three. There's others that do it on the margin, but not in a material fashion. It's really just SVB and the others to a lesser extent.
5% to 80% of the market.
Yeah, and then on the non-bank side, there's a couple large publicly traded business development companies that are NASDAQ traded. And the biggest is Hercules. They've been around as a public stock, I think, since 2005.
Yeah.
And there's a couple others that have been around for a number of years as well. Triple Point and Horizon have been publicly traded for quite a while. And there's a couple of recent entries to the space as well, Runway Growth Capital and Trinity Capital. So those are the 5 publicly traded NASDAQ BDCs that specialize in venture debt. And what's nice about the BDCs, from my perspective and from any investor's perspective, is they're required by the SEC to report details on every loan they've made. So I've looked back at every loan that Hercules has made and the others have made to 2005 and scrubbed that data, so I know exactly where every deal has priced in that market. So when I talk about numbers, I'm not throwing out numbers that can't be validated. These are straight numbers out of SEC filings. And what the big takeaway is that going back to 2005, the average debt yield aggregated across all the public BDCs has been 15% with very little volatility. It's wrapped around 15% every single year. And the warrant positions are harder to calculate because some of them haven't even been monetized yet. But on average, the warrant positions are worth about 5% annualized. So in the non-bank market, we know that the returns are about 20% per year. And there's a number of private funds as well that are very good. WTI, which actually got bought recently by a publicly traded company. They're very strong. They're one of the leaders in the space, and they've been doing venture debt since 1980 in various forms, and they're on Fund 10 right now. So I've learned a lot from them, certainly, and they're very well respected. And then there's a couple others in the market as well that are pretty solid. But there's really only about a dozen or so firms that are what I call institutional quality. And those firms, if you include the 3 banks that I mentioned, the 5 BDCs, and then a handful of private funds, they make up probably 80 to 85% of the market. So there's not a lot of capital out there in the venture debt space, which is one of the reasons why I was really attracted to this opportunity to launch ARI.
Nice. Well, it sounds like you really come upon something, and it could be a really good place for people to invest. So fast forward to now. We went through this is one of our first discussions for the year of 2023, Zach, as you know, and 2022 was one of the worst years for investors ever. And when we say that, we usually talk in terms of the stock market, and that was certainly very true. But what a lot of folks don't completely realize, it was also one of the worst bond markets. I think it was actually the worst bond market in American history. I know it was after the first half, and probably was by the end of the year. With the Barclays, Bloomberg Ag down about 12%. So bonds are never down 12% in a year. I mean, this is really unbelievable stuff. And so we've seen short rates just spike upward, where money markets and bank deposits were paying 2. Now the Treasury bill's at 4, and yet a lot of the ETFs haven't caught up. And so it's a very strange time in the fixed income market or any market, whether it be floating or fixed. What do you make of all this, and what has this done to the venture debt business?
So there's a lot to dig into here. So let's start big picture.
Yeah,
I think a lot of people historically have tended to have a portfolio of 60% stocks and 40% bonds. That's a kind of benchmark that a lot of people use, the 60-40 portfolio. And historically, that's been a great way to invest money, because you can do it relatively cheaply through index funds, or if you've got like a good advisor like yourself, that can stock pick and bond pick, you can do even better. And so that's always been a really solid strategy. However, that strategy is going to come under a lot of pressure over the next couple of years, in my view. And what we saw last year is what we'll probably continue to see in 2023 and perhaps 24 and 25. So on the stock side, what I think we'll see is a reduction in earnings, especially as the economy starts to slow and we enter what I'd call like a real recession that we can feel. So what that means is lower earnings, but then we'll also probably see a compression of the price earnings multiple, right? So you get kind of a double whammy effect. So I was looking at projections for the S&P 500 for this year coming up, and I think a lot of people are still pretty bullish on the market. I'm bearish. I think the market could be down 30% and go back to pre-COVID levels pretty easily. And if you think about it conceptually, it's not that crazy, because what did we do the last 3 years? A lot of us were sitting at home on Zoom all day, ordering everything on Amazon, watching Netflix, right? You can't convince me that we were creating real value doing that. And globally, that's what everybody was doing, right? They were doing that. They were locked up in their apartments in China until, a month ago, and now, all hell's breaking loose with COVID there, right? And so it's very hard to convince me, and I'm sure many others, that we actually created the value that prices reflect in the market right now. In other words, if we think about real value creation, I could make the case that we probably destroyed value the last couple of years, because we spent a lot of time and money investing in things like crypto, which are now turning out to be, potential zero. And look, I won't dive into crypto per se, but suffice it to say that if earnings are down because we have a recession and price multiple, the price earnings multiple compresses, we could easily be down 30% on the stock side. And that wouldn't even really take us back that far in terms of where we were at. I mean, it would bring us back to 2019 levels. Now on the bond side, I'm even more bearish, because and this is really my area of expertise. So two things are going to happen. Rates, I think, are going to continue to increase, because inflation is real and it's not going away. The Fed's got a 2% target. The official numbers have inflation over 7% still, but let's be honest. Look at things we spend money on. There's almost nothing out there that hasn't increased by at least 40% in the last 2 years. I mean, that's like the challenge I give people. Name one thing that isn't up at least 40%, and so those inflation numbers need to come down a lot officially. But on the unofficial side, in the real world, they need to come down even more. So what that means is rates are going to stay elevated, in my view, and they're probably going to continue to increase. As rates increase, bond prices fall. Now, the other thing that's going to happen as if we enter a recession, which I think we will, is credit spreads widen. In other words, as a buyer of bonds, you want to get paid more because you're taking more risk, so you need a higher yield. So not only do you have rising base rates, but you also have a widening of credit spreads. So you get, again, a double whammy effect. Just like on the stock side, where you've got lower earnings and lower PE, on the bond side, you've got wider spreads and higher base rates. So I think bonds could be down at least 15 to 25% this year coming up. And especially be careful in the long end, where the longer duration bonds, the 20-year, 30-year bonds, because they're much more sensitive to yield increases. And you're citing some of the stats earlier about bond performance this year. If you looked at corporate bonds that were long dated in that 20 to 30-year bucket, investment grade bonds like Google bonds, right? Apple, some of those were down 30 or 40%. I mean, it's crazy. I think Google had a 50-year bond that was issued in the last year or two, and it's trading at like 50 cents on the dollar. And that's pure rate exposure. It's not because of the credit risk. Nobody's worried about Google's credit risk, but just on the rate side alone, it's that bond got torched. And that's where I think a lot of people are very surprised, especially retail investors that aren't trained traders or portfolio managers. They think investment grade means they can't lose money. They think if they buy treasuries, they can't lose money. But the interest rate risk can be devastating. And so there's the credit risk and there's the interest rate risk. And this year we got hit mainly with the interest rate increases. Next year we might get hit with rate increases and credit spread widening, right? So it could be a double whammy.
Yeah. Wow. So and as far as the venture debt world goes? how does that affect? You say most of it is variable or adjustable debt, right? So it doesn't affect that market as much, right?
Yeah, I mean, what's great about the venture debt market is it's relatively insulated from rate increases. In
Good.
fact, we actually benefit as a lender from rate increases. As prime rate and SOFR have increased, as base rates have increased, the cash coupon has increased in lockstep. And all of these loans, or the majority, I should say, pay on a monthly basis. So there's very little, risk when rates go up because the coupon adjusts upward. So it's nice to be in that part of the market. And then because of the warrants that we get, that hedges against longer term inflation as well.
Yeah, well, and I've been preaching this to investors for decades now, that floating rate bonds or adjustable rate bonds aren't well known in the economy and the market, because we've been in a declining interest rate environment for most of current investors' lives. Mm-hmm. And so now only in the last year we've been raising rates, and people don't know what to do about it. But floating rate and adjustable rate bonds, whether it be other types of corporate adjustables or venture, could be a great place to be.
Yeah, and that's a great point, Brian. For our entire lives, essentially, as investors, rates have been going down. So why would you want floating? You're getting paid less every year. And now it's the exact opposite. And so it's requiring an adjustment in thinking. It's been a paradigm shift, right? And I think it's what I'm noticing is it's taking some people longer to adjust to it than others. A lot of people are still anchored to their prior views because that was the world they lived in for so long. The last 13 years, we had a raging bull market. So imagine you came out of college in 2010, all you've seen is up and to the right in terms of performance. And so every time the market went down in the last 13 years and you bought the dip, you were winning, right? Yeah. Now it's the exact opposite, in my view. Now you buy you think you're buying the dip and you're just trying to catch a falling knife, right? Right. And so that's where I think we're going to have to see people kind of adjust their thinking quickly, or they're going to get hit pretty hard.
Every low is eclipsed by a lower low.
Exactly. And
the good news is that markets do bottom at some point. So whether it's later this year or into next year, something will give eventually. And I don't know of any perpetual economic slowdown. I don't know of any perpetual bear market. So it will turn, but in the short run, you have to be careful. And using adjustable rate income programs might be better for many investors here, at least for the near term, for sure.
Yeah, on the fixed income side, what I like best is either floating rate that you mentioned, or more of a barbell portfolio where you've got front end, short duration liquid treasuries that are still yielding, a nice 4% or so, and then when the opportunities present themselves, you sell those treasuries easily and roll into better opportunities. So I think it's good to have some dry powder and good to have some liquidity, but you don't want to have too much cash sitting there because inflation's eating away at it. And that's where it's a tough market, right? We could be in a stagflationary type environment coming up. I mean, I think we already are, but it could get a lot worse. And that's where it's tough because people say, hey, sit in cash until there's an opportunity. But if it's getting eaten away at 10% a year, that's rough. I mean, you can't really hold cash for too long. Your performance is going to get decimated. So that's why I think it's good to think about opportunities where you can generate a solid return, and they need not always be liquid if you've got liquidity in other parts of your portfolio. So the portfolio construction I really like is liquid treasuries, short duration,
right,
and then some alternative exposure, private debt, and other private assets that kick off a higher yield. And a lot of those products will have floating rates. So think direct middle market loans, venture debt, some traditional leverage loans or bank loans. And then there's other interesting products out there like infrastructure debt, real estate debt. But I think debt's not a bad place to be, provided you're not in too many fixed rate coupons, right? And you've got a big chunk of that in variable rate debt.
Great. Well, this has been a great discussion, Zach. I knew when we were talking about it, and I think venture debt is an area that most investors didn't even realize were around. Maybe institutional investors did, but not individual investors or high net worth families. So now that's available to them through programs like yours and some others. So I just wanted to make sure that we got a chance to talk about it. It's been a great discussion. Thank you.
Yeah, well, thanks for having me. It's always great to get the word out because it is a product that's not well known and certainly misunderstood by most. And what that means is there's opportunity. And so that's a good thing in a sense. You want to be in products that are not commoditized, that are not well known, that are not overcrowded.
And also, as you mentioned, the markets change. And so we may have our paradigms that we believe everything will fit within. And then all of a sudden, the whole world changes. And it seems to be doing that right now. And so these are areas that investors might want to look at. And I would caution investors to talk to your financial advisor. And you can call us at 4-Star, and we know a lot about this as well. And work with folks like Zack and others that can give us really interesting things to invest in, things you're not going to hear from the typical stockbroker type person down the block.
Yeah, and I think that now is a great time to have a trusted financial advisor. And one of the things that I really like about you, Brian, and as I've gotten to know you offline, is you really care about your customers, and it's all about your customers. It's about taking care of them, and you'll go to bat for them every time. And that's actually relatively rare. I know a lot of folks that are wealth advisors and wealth managers, and I think that your commitment to your customers really stands out and sets you apart.
Well, great. We appreciate that, and that's searching for anomalies and ideas like this is all part of that commitment for our investors. It's keeping fresh ideas, making sure that we're on point on what's really happening in the economy and understanding it and knowing how to react and not lose money in a bad market and how to make good money in good markets. So great discussion, Zack. We're going to end it here. I really appreciate you joining us today on today's Market Explain, a 4-Star podcast and video series. And let's raise a glass to 2023, huh?
Let's do it.
It's going to be a great year.
It will be, especially if you've got good advice.
Thanks, everybody, for being with us. And we'll be back again with another really great interview and a great discussion like the one we just had with Zack. We'll leave it there, everybody. Thanks for being with us.